This is Trepp Wire Week in Review for week ending May 14th. I'm Martha Kocher with Trepp, a data modeling and analytics firm for the CMBS commercial real estate and CLO markets. I'm with Manus Clancy, Senior Managing Director, and Joe McBride, Head of CRE Finance. This week, COVID cases and deaths hit a 10-month low, and the CDC recommends the Pfizer shot for kids 12 and older. And released data point to an economy that is running hot. Stocks made some recovery after inflation concerns for both consumers and companies. Consumer prices rose sharply again in April and drove the rate of inflation to the highest in 13 years, and the producer price index rose 0.7%. All this on the heels of last month's disappointing job number, with job openings popping to a record high as employers struggle to fill positions. And in the Southeast, some reported gas supply issues as a major pipeline got hacked. So Manus, the data this week confirms that inflation's a real issue. Is it a short-term reopen shock?
Well, I think that's the $64,000 question, isn't it? Right? It was a week of big surprises. We last recorded the evening before the April jobs report came out. That came out Friday morning and was extraordinarily underwhelming. People were expecting, including us, 1 million new jobs added. It came in about 800,000 below that number. So people are not coming back to work for whatever reason that may be. And of course, the political pundits all have their reasons for that. Job openings came in hundreds of thousands above what people were anticipating. Then we got on Wednesday, the CPI number, which was year over year, more than a full percentage point above what was estimated. The monthly number was a multiple of what people had been expecting. That led to a big sell-off in stocks on Wednesday. But on Thursday, we saw an equally hot PPI number, and yet stocks rallied. So there seems to be this tug of war going on between those that believe that inflation is here to stay and is going to be hard to wrestle to the ground from the Fed. And there are those that believe, the word people are using is transitory. And I think that the scale is evenly weighted between the two. For CRE listeners, CRE pros, one guy on the side who thinks that the Fed is losing control was Barry Sternlicht this morning on CNBC, who basically said, the supply constraints and the price hikes are really taking their toll. And he's very concerned at this point, but it remains to be seen, right? Maybe in 6 months, this does turn out to be transitory, or maybe it becomes something that really throws sand in the gears of the economy.
Did you see that satellite image of all the Ford trucks lined up that they're just not done because they can't get the semiconductors, right? You've got lumber, you got chicken, you got semiconductors, and you have workers all in short supply right now. And some more numbers, the numbers that Powell looks at the Fed, they look at that core CPI, which excludes food and fuel, which I find to just be hilarious, because what do you spend more money on as a consumer other than food and fuel? I mean, I know in my house, it's like 95% food at this point, our monthly expenditures, but the core CPI was up 3% year over year, which is obviously 100 basis points over their 2% target. And the core was up 90 basis points month over month. I mean, I don't expect the 90 basis points every month, but if you annualize that, that's like over 10% inflation, which is just out of this world, right?
Right. Well, the non-core, the headline number was 4.2, and on the PPI side, it was over 6. So, I mean, those are really numbers we haven't seen in a long time, right? We haven't seen that kind of CPI number in more than a decade.
It's pervasive, right? It's this whole kind of wrinkle in the supply chain, which has been happening for a year, is like finally coming home to roost everywhere, right? Like the only retailer that can get me anything within a few days is Amazon. Like anything else, furniture, like I went on looking, needed new shoes. Like you can't find shoes. Like they're just all gone. Everything's gone and out of stock.
You can get golf shoes from Dick's in like a day.
Not in my size, Martha.
Sure, you got
6.5.
That's true. You got big feet.
So anyway, the thing we were talking about before, what does this mean for real estate, right? And I'm no macroeconomist. I think, Manus and I are experts in CMBS and, CRE finance, but very not experts in almost everything else. But, you have the positive side of inflation for commercial real estate and real estate in general, which is if people are making more money, you can raise rents, right? And your top line revenue may increase, right? Now, I don't know if that is outweighed. I think it may be outweighed by your expenses, right? Your wages, your overhead go up. Here's the thing, Powell has to make a decision at some point when and if inflation is running too hot, and then he will have to raise interest rates, at which point, cost of debt goes up, cap rates should increase, and all those types of things. But again, this is like the macroeconomic thought process, which doesn't always play out in reality.
Well, the interesting thing for me is how detached the stock market and the bond markets can be at times. And for commercial real estate guys, the thing that you're looking at is that 10-year treasury rate. And after the dismal jobs report on Friday, the 10-year kind of plunged. It got under 150 for a short period of time. As people thought this is going to give Powell just what he needs in terms of keeping bond purchases in place and not raising rates, the weakness in the job market. When we saw the CPI number come out, we did see a jump in interest rates, but it wasn't catastrophic. Like, we didn't even get back to where we were in January and February when we were at about 175 on the 10-year treasury. I think we got up to about 165, 166 this week. So even though stocks were spiraling lower on this inflation threat on Wednesday, bond yields weren't spiraling higher. And what we didn't see also was huge moves in either CMBX or CMBS spreads. So, and this happens from time to time, right? Bond investors see one thing and stock investors see something else. And right now that's the case, right? Stock investors are laser focused on this inflation question, and bond investors think, it's no time to panic. Well, one more point on the inflation side, kind of pulling together many things that we talked about at the beginning, is that I was driving to Queens yesterday from Westchester. And for those that know that area, there's 2 gas stations on the expressway going to the Whitestone Bridge where they charge phenomenally high prices for gas. It's kind of no gas for 100 miles type thing when you go into a desert. And there they charge $4.99 a gallon, where the rest of Westchester is about $2.90 or $3.25. And my 19-year-old, who I would not say is very on top of current events, said to me, wow, that pipeline shortage really took a chunk out of people's pockets, right, with gas prices. He didn't realize that this is the last chance gas before you get to the bridge, and they charge $2 more than anywhere else in the country.
That's the one with the Dunkin' Donuts too, right?
Right. There's one on the southbound side and one on the northbound side, $4.99. In fact, it was $4.79 yesterday, and that didn't stop them from bumping it up because of the pipeline condition. Today it was $4.99.
Whew. Well, a couple more points and then we can move on. I think one piece of the report, which I found to be interesting, we talked about the reopening, right? And places where people go having to reopen or struggling to reopen because they can't hire people, right? First thing is McDonald's raising how much money they're paying their employees. That's going to have to happen across the services industries in order to lure people back. However, McDonald's is one thing, but a mom and pop restaurant, their margins are razor thin to begin with. So I don't know how this plays out. They're going to have to raise their prices significantly, or they're going to have to get by with fewer workers. And something from the report on the hospitality side of the world, month over month, hotel wages were up 1.6% and 5% year over year. So, again, good for the workers, but maybe not if, these hotels are bringing back fewer workers or they're not able to open at all because their costs are just too high.
One of the publications pointed out, and this is probably true, that you can't reverse course right? If you're used to paying somebody $12 an hour and then you pay them $15 an hour to come back, and eventually, the wage pressure is reduced, you can't go back to them and say, we're paying you 12 now. You're kind of stuck with this 15. And this article that I was reading was suggesting that some small business owners will not open at all until they know they can pay 12, right? That they can't pull off 15. And if they're going to struggle to find workers at all, why go at all, right? Wait until the economy cools off a little bit and you could really go back at the cost you're anticipating in kind of full employment.
Slight non sequitur segue here and a plug. We interviewed Jim Shevlin, who basically runs CW Capital's special servicing business and a couple of other things that they do there. And it just made me think of it because one of the things that he mentioned was their company was sized to handle the amount of loans that were in special servicing on their books pre-COVID. And then all of a sudden they went up by 6x in terms of how much was in special servicing, and they had to bring on a bunch of people. Now it's totally different scenario there, different type of workers and kind of pay scale. But I thought I have to give that plug because I think when we release that episode next week, that's going to get a lot of interest. Get into the mind of a special servicer.
So now we're going to pivot and spend some time diving into retail. There were a number of stories that we're going to walk through.
Well, normally we talk about themes and, what ties all these stories together. This week it's more of a potpourri, if you will, a mixture of just
a grab bag.
A grab bag, right? That's probably a better term for it. And we'll run through some of the things we've been watching this week. On the negative side, Brookfield announced that it had reduced its portfolio. There's an article on Retail Dive that talks about this. They handed back the keys on 3 malls, Florence Mall in Kentucky, the Bayshore Mall in California, and the Pierre Bossier Mall in Louisiana. So those are, according to this article, no longer in their portfolio. All 3 of those backed CMBS loans. For those that might recall this, we put out in January a list of loans for which the borrower had indicated they were likely to give back the keys. These malls showed up on this list, or at least the Florence and the Bayshore did. Later, it became apparent that the Pierre Bossier Mall was also going to join that list. So it's not a big surprise to our research readers, but sometimes these things are fluid. So until it really happens, there's always that chance that Brookfield has a change of heart and doubles down their efforts on trying to make it work. But in this particular case, they cleared the decks on those 3 malls, and now they will become REO in their reporting once the servicer updates their data, likely in May. Another in the potpourri or the grab bag, again, Brookfield, they announced that they were selling off their interest in Forever 21. The interesting thing about this is they acquired the firm along with Simon and Authentic Brands at bankruptcy auction last year. They now announced that they've gained $63 million from the sale. So there was a recovery in the value of their equity purchase that allowed them to turn a profit on taking this in. Also on the big commercial real estate front, we like this one. This was a positive story. Vornado, in their earnings call, revealed that they extended the lease for Todd's, TOD, apostrophe S, no 2 Ds, at 650 Madison Avenue in Midtown Manhattan. Why is this one interesting to us? Well, number one, we've noted many times before that New York City street level retail has been hit hard during COVID. Todd's is a shoe seller, a high-end shoe seller, street level retail in kind of the 50s in Manhattan, 52nd, 53rd Street, something like that. And Vornado was able to get a 7-year renewal on that. Now, the shoe retailer represents only 1.3% of the square footage in that particular property. But as is often the case, they have an outsized percentage of the base rent at the building. In this case, when the CMBS loan was made in 2019, Todd's represented 7% of the underwritten base rent compared to 1.3% of the square footage. So extending them for another period of time is great news. That particular building was a source of concern for us in the past because Ralph Lauren is occupying a big percentage of the office space in that building. They're looking to reduce their footprint by 30% nationwide, and their lease ends in 2024. So some of the potpourri stories we're talking about, a couple more I'll throw in. We did see a West Virginia legacy mall sold. The Charleston Town Center Mall was acquired by the Whole Property Group. They expect to continue operating the property as a mall. So now there's really, well, they've been in there for a while. They have 33 malls in 16 states, but you could add them to Namdar and Cohan as, big bidders on these distressed assets that are sitting out there. In this particular case, the mall was an REO asset of a 2007 deal. It had a $91 million outstanding balance. The last value that we had seen from servicer data was 25 million, but the price was not disclosed as part of the Whole Property Group's purchase. And then lastly, one more positive story. We saw that Macerich added the Irish fashion retailer Primark to its tenant roster at 2 malls. One was the Tysons Corner Mall in Tysons, Virginia. The other was in the Green Acres Mall in Valley Stream, New York. The latter backs a single asset deal. That single asset deal has been one we've been watching for a while. It had lost JCPenney and Sears as collateral tenants over the last couple of years. The borrower was able to negotiate a 12-month extension. So even though Primark might not be all that big a tenant, not a big name for sure, they only have about a dozen stores in the US. That's at least something in the right direction, putting a new tenant in that Green Acres Mall.
Valley Stream, like Long Island?
Nassau County.
Yeah, so I'm gonna have to go check that out. I want to see what Irish fashion is, as somebody named McBride, somebody named Clancy. Maybe we'll make that a little podcast road trip edition.
All I know is, as a guy who really roots for our clients, for Trepp's clients, I'd like to see that 12 US store location jump to 120 and give these mall owners a little bit of lift.
Yeah, so just another couple potpourri items here on the retail space. L Brands came out and made an announcement that they're splitting up their 2 assets. One is Victoria's Secret and the other one is Bath and Body Works. I can never say Bath and Body Works without first thinking Bed Bath and Beyond, but there were some interesting tidbits from the announcement and also from their earnings last quarter. They had a fourth quarter beat, net income 860 million compared to last year's loss of 190 million. Their operating income rose 58%. Victoria's Secret, even with all that, Victoria's Secret annual sales fell from 7.5 billion to 5.4 billion, but their earnings are increasing in large part due to the fact that they're closing a lot of stores. I think they're reducing a lot of their overhead. So, I think one of the themes or lessons coming out of this is that in this day and age, with a strong brand, you can make money online. Right? I mean, I'm not saying anything that's earth-shattering here, but these stores or these companies that are thinking that they need to maintain their footprint in a very large way, that may not be true. And if there's more stories like this where a Victoria's Secret can reduce their footprint and increase their EBITDA, basically, you might have to watch out for more, brands going this direction. There's also part of the story is that they're looking at splitting up the 2 companies. The other one was, Manus, you mentioned Simon Property Group, and they had their earnings come out. And just a couple of items from their occupancy as of end of March 2021 right now is just under 91% across the portfolio. That's down from 94% last year. It's still like a pretty reasonable number given all this we hear and talk about in retail. Their lease rates actually or their minimum rents per square foot are slightly up from last year, but mostly flat. And David Simon in the earnings call, now take this with a grain of salt, coming from a mall REITs CEO, He said between being cooped up, being locked down, and celebrating that the country is still around, there's clearly some level of euphoria around that. So I think he's telling the story that people are dying to get out, and that his malls will do okay coming out of this.
Yeah, I think on the Victoria's Secret side, I'm not sure that there's any other retailer better fitted for being online than Victoria's Secret. I've never been in
No
one.
pun intended.
No, I mean, I've
Don't you have to
never been in
go
one.
though to like know if something fits? I mean, can you even try stuff on? Can you try that type of thing on? I don't know.
Yes.
a little
Just to let
creepy.
you guys know. Yes, you can.
I mean, I just think, when I go to Kohl's and I buy some new boxers, I'm not holding them up to my waist to see how they're going to look on me. I just throw them in a bag and I leave, right? And I can't imagine like
You
doing
steal
that.
boxers from Kohl's?
No, I don't steal boxers from Kohl's, but I don't try them on and I don't look how they're going to look on me, right? I just grab a 6-pack and move on.
I have so many thoughts.
Yeah, I have a lot of
jokes that are coming to my mind right now about this, but I'm going to hold off.
no.
You comparing yourself in Kohl's with boxers?
Yeah, it's
versus-
scary. Everybody knows that Victoria's Secret was kind of losing ground before the pandemic, right? Women, I think in general, wanted something that was possibly more comfortable, possibly, more practical. And at the time, they were not inexpensive. Now, interestingly enough, they have increased the price. And one of the metrics that they noted is that their price per footstep or dollars per footstep has gone up. So they are looking for leveraging their brand, even if they have fewer stores in malls, possibly through both online and just fewer stores in general.
More dollars per footstep. I'm all about that. As long as the dollars are increasing and it's not just the footsteps decreasing, right?
So let's turn to office.
Another couple stories we're looking at this week. Some have already come out in our research. Some will be coming out on Friday morning. One of the positive stories was that the San Francisco Business Times was reporting that online banking tech firm Chime is close to signing a lease for 200,000 square feet at 101 California in San Fran. The story notes that this would be the largest lease in that city since COVID-19 began. The office backs $755 million in CMBS debt, which is spread across a single asset deal and several 2019 conduit deals. The office has about 1.25 million square feet. So Chime would represent about a sixth of what's in there. The signature has not been made yet, so it's still just something in the works. But the top two tenants of that property have leases that end over the next 2 years. So if the owner of that property were to land Chime, then that would cover whatever potential losses they may have. I believe the top two tenants are banks, if I'm not mistaken, investment banks. Another story we're watching, The Real Deal reported that the Townsend Group is selling its 90% stake in the Citigroup Center for $300 million. They're selling it to Monarch Alternative Capital. The property used to be known as the Miami Center. Now it's the Citigroup Center. It backs $172 million in CMBS debt across two 2012 deals. What we like about this story is that, at 300 million representing 90% of the value of the office, you're talking about a $330 million valuation. This same property was valued at about 270 million in 2012. So about 60 million in asset valuation for a property that in Q1 2021 was only 69% occupied. So a nice story there. And two other things we kind of watched this week. We like these two articles. One was in D Magazine. The other was the Charlotte Observer. Both of these publications put out really, really detailed articles on how much space is available in each of those markets, going building by building. So if you need those stories, we're happy to send you the links. In D Magazine, they talked about, I believe, 7 different properties that have at least 500,000 square feet of space available. And they use the very inflammatory term that some of these buildings may be functionally obsolete. So for those with a weak stomach, this may be ones to stay away from. The Charlotte one was just unbelievable. 22 different projects across hotel, office, and multifamily in the works as that city continues to explode.
Another potpourri, we also saw Blackstone announce that it wants their fully vaccinated workers back in the office on June 7th. Forget about Labor Day, bro. You're coming back, right? And JP Morgan also told, this is from a Commercial Observer story, JP Morgan told its UK-based staff to return to its London and Bournemouth sites. I don't know how to say that. After June 21st, according to a memo. So seems like at least, the banks, I think, were always going to lead the way back in terms of getting people back in the office, but that Labor Day concept might be moving up a little bit.
Yeah, I think that there's a lot of momentum. I think that there's, when you look at the scale in this regard, it seems like more companies are coming under that umbrella of we want to do something before 4th of July than others that are saying we're permanently working from home, right? More headlines about people asking their workers to prepare to start doing the commute again, which I think is great for property owners and even better for getting economies going like New York and San Francisco and others. I'll throw one more thing in, a couple of other headlines we watched this week. The migration of firms to Texas continues. We saw 2 more headlines of firms moving their headquarters to the Lone Star State. Green Dot is moving from California to Austin, Texas. I think that they're a fintech firm, if I'm not mistaken.
I think they're like a debit card type of company.
And the other is NRG, which had dual headquarters in New Jersey and Houston. They're going to add to their Houston presence and unfortunately abandon New Jersey as a headquarters. So, Houston, we've talked about before, really hammered over the last 5 years in terms of shadow space available. So seeing NRG commit to that space where they already have 3,000 workers is a very positive sign for that city.
We're going to be seeing stories and tweets for the next 2 years on, especially in, the bigger northern cities, about workers coming back, then deciding they don't want to come back, or a slight spike in cases happens, and then how do different companies respond and everything like that. To me, this is going to take some significant leadership and fortitude from, corporate leaders to say, here is the date. We're coming back on this date. And sure, we're hybrid, but you have to be in 3 days a week, or we're going back full time. Whatever the answer is, I think that the uncertainty is what kills everybody. If we could just say, hey, listen, the day after Labor Day, everyone's back in the office. And if you have a specific reason that you feel unsafe being in the office, that's something that you take up with HR or something like that. I think, but there's going to have to be that fortitude when there's an increase in cases in the winter or the fall, there probably will be because of seasonal reasons, right?
Well, I love the idea of there being fortitude and courage and everything else. I do think it's going to be challenging. You could throw down the marker, but if somebody comes to you and says, I have a pre-existing condition, or I'm nervous about this, and people start talking about corporate liability or forcing people to have vaccines and so forth, I think you get into very shaky area right there in terms of what you can precisely tell an employee in these regards. And I think as tough as a CEO may want to be in terms of towing the line, it may not be as effective as they want it to be. Yeah. And that's, I do think that that's the bottom line. And if, God forbid we have issues with schools again in September, right, it could really unravel even more, right? If the big cities, are having, 3 days a week in person and not 5, that too would provide a big challenge.
Another plug for our friend from CW. They just moved into he said this on the podcast, so I can kind of relay it here. They just moved into new space and they actually reduced their footprint by about 20%. They're in a newer, nicer, kind of more modern space, which they really like. But how is it that not every CFO in America has this same thought process when their lease comes due over the next 5 years? Like, that slow burn in office is just really something to worry about in my mind.
It's a concern for sure.
So let's turn to the April payoff report, which we released just this week.
So for those that don't recall, what we do is we track of the maturing loans each month, what percentage pay off. This can be a very lumpy number from month to month. A single big $200 million loan that doesn't pay off can really inflate the number, the percentage of loans that fail to pay off. And that's what we've seen in the last 2 months. I think we were at about 55% 2 months ago in terms of percentage of loans paying off on their balloon date that were still outstanding once they reached that date. Last month it was 44%, and this month it dropped below 25%. And the reason is because of that lumpiness. In each of the last 2 months, we've seen some of these big 2011 shopping mall loans that were securitized 10 years ago fail to pay off. And what that means is, one of several things, right? For the weak performers, it means that the borrower can either throw back the keys and say, I'm done, or try to negotiate some kind of modification, which could push out the maturity date. The Pyramid Group was pretty good, successful at doing this for several of their loans in recent months. For the stronger malls, it just may mean they need more time to get refinancing. Like we saw, for example, last month, the Willowbrook Mall did not pay off on time, but the special servicer notes said that they were anticipating being able to refinance by May. So that can move the number quite a bit. When a loan doesn't pay off and the servicer continues to advance, that's kind of a win for the interest-only guy. If it's less successful, right, if you have a big loss on this, it's still kind of a win for the IO guy because he gets more interest for a longer period of time, but it's a negative for the bondholders who could see losses coming from the bottom up. So that's a big driver right now, and it will only become a bigger driver for the next 2 years as retail really dominates the percentage of maturing loans.
Manis, give us like a 20-second education segment on why do CMBS investors care about this number? Like, I don't mean like, obviously if things aren't paying off, that's a big deal, but the speed and the timing of the payoffs.
Well, the interesting thing was this idea to come up with this report came about 10 years ago from a long-term client of us, who I won't name, but is a major buyer of CMBS. And what they were looking for at the time was, are these IOs worth buying in the depths of the follow-on from the great financial crisis as a way of juicing my income, right? Can I buy these things assuming that 50% are going to extend for 2 or 3 years, and I have 2 or 3 years more of income on a particular loan that I wasn't counting on, and the market is not factoring in? And sometimes once you build these reports, they just perpetuate and they live forever. And that's true of our loss reports and our delinquency reports and so forth. And, for a while, it wasn't really material. When things were performing very well in 15, 16, 17, 18, you would see 75, 80, 85% of the loans pay off on time. Now you're back. Last summer, we saw some numbers where only 9% or 5% of the loans paid off. And if you're the IO holder, you're just, cashing checks much longer than you anticipated. With that explanation, I will give you the other side of the coin, which is the one that we're always afraid of, but it doesn't really manifest itself very often. We will be writing early next week about a loan, a $72 million loan that was made in 2018, a 10-year loan that wasn't slated to mature until 2028. The lender, the IO lender, the guy who bought the IO piece, therefore expecting interest on this particular asset for another 7 or 8 years. We learned this month that this loan was able to pay off at par, neglecting the lockout option. So, if the extension is nirvana for the IO holder, This is the 2x4 in the back of the head, where you think that even as this thing goes south, it'll take years to resolve. When the special servicer allows this payoff without lockout, you're hitting the back of the head. And that doesn't apply just to the IO. All the AAA bonds in this deal were trading for premiums, big premiums, some as high as $14 above par. That too, to the extent that its average life gets decimated, this particular loan made up 8% of a deal. To the extent that this wipes out a lot of that premium, that's another 2x4 to the back of the head.
You're making me think of Tommy Boy when he hits Chris Farley in the side of the face with the 2x4.
I always think of Robert De Niro in...
Not so much here or here, but right here. Is there anything? No, you're fine.
I'm always thinking of Robert De Niro in The Untouchables with a baseball bat, which is a much more gruesome and less...
Great opening scene to a movie. That's one of my favorite movies, The Untouchables.
It is a great movie. It's right up there with The Fugitive and Shawshank and others in my put down the remote category.
So shout outs of the week. I'll start with saying that our 1031 exchange conversation spurred on some emails on both sides of the issue. So we had folks that were both in favor and against closing the loophole. And we had one writer that said that the 2019 survey from the National Association of Realtors found that multifamily properties and single family property rentals make up a chunk of the 1031 exchanges. And on the flip side, someone noted that it isn't being eliminated, which is a true point, and that the amount of the gains eligible are being capped. So the loophole is still good to go for the small investor. So thank you for those that did write in on your opinions one way or the other.
One of these people said that we have a shtick. I think that we're just being ourselves.
I think you got a shtick, but one person's personality is another person's shtick, I guess.
Going back to the point at hand, it would be a great point counterpoint to get two people on this, one a defender of the 1031 as is, and somebody who wants to see the other side of the coin. Because there are a lot of social implications for this, right, in the matter, and it would be great to hear voices other than ours.
Turning to some of the other shout outs, Brian B. heard your comment, Joe, about Invitation Homes and American Homes for Rent, about buying single family homes, reducing those homes for families. And he said, sadly, this has already happened. There was a ton of this activity about 7 or 8 years ago. We had someone on Twitter who said, so whose news don't you delete from your inbox? And Sarah said Trepwire, so thank you. Joe D watched WeWork on our recommendation and was actually looking forward to the actual jobs commentary after that jobs number came out, the disappointing number. Gavin Stewart was interested in the community call. Michael Bull, who's been a previous guest on the pod, reached out. John F. liked the 1031 exchange information. John T. is a grad student and is learning a lot. Once again, Manis and Joe, you're shaping young minds, so watch that.
Watch out.
Matt O. wanted to see some information that we had sent, and I thought this was funny. Faller Financial on Instagram said, Martha Kocher, which is myself, and my band of Treppsters do a good job of producing insightful commercial real estate information every week. So
I like that. We've always called ourselves Treppies, but Treppsters sounds pretty good.
I think I like Treppster.
I like the Pips. We're the backup singers for Martha's band.
Yeah, lest anyone be fooled. We were remiss last week to give a shout out to all the moms in advance of Mother's Day, and that was a big miss on our part. We're usually pretty good about that. So if for whatever reason any of our listeners forgot, a number of retailers have extended their flash sales through May. You might be able to get to your mom a sign of your appreciation, albeit a little late.
Just don't go to Victoria's Secret.
That would be weird.
And if you missed it, you ain't coming back. It's over for you.
Right. Too much blowback already.
Yeah, exactly. With that, we'll close. Thanks to our producer, Haley Keene, who's a Mets fan, I hear. Join us next week as we review what's happened during the week and how it may be impacting you. If you have a question or comment, send an email to podcast@trepp.com. And for more info, subscribe to the podcast with your favorite provider. Thank you for listening and stay well.
All right.